Purchasing takes a lot of our time. Why? Because we want to buy a best thing for us. Be it a small mobile or a big car, we do a lot of research before buying it so that we know that it also fulfills our expectations. The same approach must be considered for investing on mutual funds too. So what are the key things that you must consider before you invest on mutual funds? Hello and welcome to IndianMoney.com. I am Juhi and today I'll tell you the key factors you must consider before investing on mutual funds. Let me tell you one thing, that mutual fund is subjected to market risk and therefore you have to be ready for both profits and loss. You cannot go into mutual fund investment if you think that there is only profit and no loss. There are losses. So always keep that in mind. Now let us begin with the points to consider before investing on mutual funds. Number one is different mutual funds comes with different level of risk. Every mutual fund is associated with some level of risk. Some mutual fund will have low level of risk, some will have a high level of risk. So as an investor, it is very important that you choose mutual fund according to your risk appetite, your financial goals and your financial standings. And although equity mutual fund has a lower risk level, compared to the direct mutual fund, you must understand that there is still risk associated to it. Moving on to the second point is plans. Both regular and direct version of mutual fund are the same fund. They are run by the same fund manager and the investment is done on the same stocks and same bonds. So the only difference is that in the direct mutual fund, you have no broker or commission in between. So as an investor, you get higher returns on the same mutual fund. Moving on to the third point, which is returns. Normally mutual funds are annualized returns. So this creates an impression in the buyer's or the investor's mind that this will always give you the same return or same result as the previous year. But this is not the case. Suppose you have invested on a certain mutual fund scheme and you get a return of 7%. This does not mean that the coming next year you will get the same percentage of return. You can either get it, you can get more, you can get less, you can even face losses. So it's very important that you understand that the returns that are coming are not equal or not same all the years. Moving on to the next point, which is consistency of return. It is very important that you note down the consistency of performance of a fund on certain mutual fund so that you can control your losses and you can get higher or good returns. Say for instance, there was a 5% fall this year. Now your mutual fund has to generate 11% of return to cover the loss and give you that 5% of return. This helps you ensure good and higher better returns when it comes to mutual fund investment. So it's very important that you see that a fund is having a consistent performance. Next, let's talk about SIP. SIP stands for Systematic Investment Plan. This plan allows an individual to invest on a regular interval, create a wealth for long term and reduce timing risk. It also helps in getting better rupee cost averaging. Say the market goes down. Now you can get more units on the same price, helping you reduce the overall investment cost. Moving on, let's talk about the last but not the least key factor that you must keep in mind before investing on mutual fund is asset allocation and periodic rebalancing. Let us first talk about asset allocation. This refers to an investment strategy where the individual divides their portfolio into different assets. They diversify their portfolio into different assets to minimize the investment risk. This basically helps in lowering down the investment risk by diversifying your portfolios. Moving on, let's talk about rebalancing. Rebalancing of your portfolio means buying or selling of assets to maintain a right level of investment risk that you are comfortable with. This also helps you in achieving your goal and it also enhances your portfolio returns. Now let us summarize whatever we have learnt in this video. Different mutual fund will have a different level of risk. Direct plan will get you higher returns. There is risk associated with every mutual fund, low or high, but there is always a risk associated to mutual funds. You won't get the same returns every year. Consistency of fund is good. SIP helps in rupee cost averaging, and asset allocation and periodic rebalancing is really crucial for your investment. That's all for today's video. Hope you understood the key factors you must consider before investing on mutual funds. If you want to learn more about mutual fund investing, you can do that on our Financial Freedom app with our mutual fund course. To download the app, click on the link given in the description box below. If you like the video, hit that like button. If you are new to the channel, subscribe and hit that bell icon so that you get notified of every video we post. For more informative videos on stocks, investment, farming and more, keep watching IndianMoney.com. This is me, Juhi Singh, signing off. Be wise, get rich.